Every single year, the stock market corrects, sometimes by 10%, sometimes by 20%, and sometimes it crashes 60% also. Investors who survive these crashes, they end up making most money on the other side. So people keep asking, will the market crash? Now, that is the wrong question to ask. The right one is, what happens if the market crashes and what you should be doing about it? So in today's video, I'm going to show you the best case and the worst case portfolio outcomes in case of a market crash. And I'm using real data from the last 30 years. And once you see what I'm going to show you, you will invest in a very different way. By the end of this video, I will show you how to stress test your portfolio, prepare even for the worst market drops, and use the surprising Costanza strategy to invest better. One of the worst crashes was 2008. Market crashed 50% from the top. Imagine you invested 1 lakh at the top of the market, and in the next 5 years, this is what would have happened. First, your 1 lakh became 50,000. Then, in another 1 year, 50,000 doubled and it came back to 1 lakh. And for the next 3 years, market went sideways. It was stuck around the same level. So over 5 years, that is 2008 to 13, market gave zero returns. But SIP investors, they had a very different kind of an experience. So if we invested 5,000 rupees SIP every month starting 2008, you would have yet made about 8% annualized return, because the path that the market takes is more important than the final destination. By averaging lower cost month after month, SIP investors gained even in a flat market. For example, let us take this active fund only for illustration. It's not a recommendation. 5,000 you invest every month for 5 years. You are starting at the peak of the market. Technically, it is called bad time to invest. So let's say you started at the worst time and then you did the SIP for 5 years, that is 2008 Jan to 2013 Jan. That is for about 61 months. Your total investment through SIP would have accumulated to 3.05 lakhs. By Jan 2013, your portfolio grew to 4.5 lakhs. Impressive 16% XIRR. Why did this happen? It's because during this period, market went through a crash. And when you first invest regularly through SIP, lower prices actually works in your favor. You buy more units at a cheaper rate, and when the market eventually comes up, it boosts your return. So SIP investors should not fear a crash. They should actually welcome it. Actually, what they should worry is about a market that rises soon after you start your SIP. If the market shoots up too quickly, than crashing or staying sideways for years, imagine the reverse of 2008-2013. First, the market doubles, then it falls 50%, then it drags sideways for 5 years. In the structure, your SIP would struggle to deliver strong results because you have bought more units at higher prices than at lower prices. So the key point I'm trying to say is your SIP outcome does not just depend on where the market ends, but the path it takes, right? That's why correction, say a 15 or a 20% correction every year, is not something to fear. In fact, they are what makes SIPs work. Which brings us to the chart put out by Capital Minds. This is the past 30 years Nifty 500 yearly returns chart. Green bar shows year-wise return, that is the annual total return at the end of the calendar year. The purple bar shows mid-year maximum crash, that is the maximum correction that happened during that year. This contrast, it clearly shows how markets often recover after a deep correction even within the same year at times, and how staying invested through SIPs during this allows you to benefit from these rebounds. One thing that stands out to me, to earn equity returns, you must endure equity crashes. Let us see some examples. In 2006, market crashed mid-year 32%, yet by the end of the year, it delivered plus 36% return. In 2008, the maximum correction was minus 64%, but by end of that year, it still returned minus 57%. But the next year, if you had stayed on, your calendar year return was 86%, even with a mid-year fall of 19%. Even during the COVID year, mid-year crash was about 38%, but year end you made a positive 18%. Markets fell on an average every year minus 22%, that is mid year, yet it delivered plus 12.5% annualized return. Even blockbuster years such as 99 and 2003 came with its own drawdown. Over 30 years, 77% of the years ended in positive, even though every year had mid-year corrections. For rest of the years, if you had waited a few more years, you would have seen a good positive outcome. With this, you can prepare mentally for a fall of 22% every year and see how this helps your SIP ride this U. So the bottom line, volatility, that is the market correction, is not a bug. It is a very regular event. Every single year at corrections, investors who stayed and invested captured 12.5% CAGR. That is 1 rupee became 34 rupees in 30 years. This is before taxes and cost. When the next minus 10% or minus 50% correction hits, the news headlines are screaming crisis. Remember this chart. So expect 20% correction every year. In a few occasions, you can expect even higher crash, 30%, 40%. Use SIP to automate decision making. Otherwise, you may freeze during panic. You will not be able to act then. Have an emergency fund of 6 months, 12 months or more, so you never have to sell during these crashes. Don't fear these purple bars. Those mid-year crashes are not signals to exit, but these are opportunities to accumulate more units through SIP at cheaper prices. Now, when the market eventually recovers, those extra units bought at a discount will help you compound those bigger gains. Some of the best long-term returns are born out of the worst short-term crashes. Let us prepare your portfolio for a worst market correction through a stress test. Ask yourself, what if the market falls 50% tomorrow? How would that affect your asset allocation? 80% of your money, let's say, is in equity. That is 80% of your total net worth, of the total investable amount that you have. And a 50% drop means an overall loss of 40%. Can you handle that without panicking, without selling at the wrong time? If not, it's a signal for you to adjust the mix, reduce the equity, increase bonds and other alternative assets that are not tied to stock market. For example, if your portfolio is 50% equity and 50% bonds or other assets, a 50% drop in equity markets would translate to 25% drop in your total portfolio. Ask yourself, can you handle that without panic? If not, it is again time to adjust your allocation. So you will have to arrive at the equity versus other asset class ratio and rebalance your portfolio to meet that guidance. Next, match your portfolio to your temperament. A conservative investor should not be 100% in high growth funds. A retiree relying on income might need more yield oriented assets. Finally, scenario thinking applies even at the level of choosing your initial investments. Evaluate both best and worst case outcomes for any stock or for any mutual fund before you are committing the capital. The goal is not to predict the future, but to build a portfolio that survives the worst and it benefits from these rebounds. There is a counterintuitive idea called Costanza strategy, named after George Costanza, the guy whose instincts are always wrong. The strategy involves making investments at the worst possible time, such as say market highs or when valuations are very stretched or just before a crash. Most of us feel that we may be buying at the market peak, at valuation high, at the top, and after we buy the market may crash and we may sell at the bottom. It feels like the worst thing that you could do. But here is the eye-opener from this research. As per this study, even if you bought S&P 500 at the absolute yearly highs every year for 20 years, your annualized return would have been just 1% lower than if you had perfectly timed the yearly lows, which is technically not possible. In other words, even the worst timing, that is investing at the wrong moment, hardly made a difference over the very long term. SIPs automatically apply this Costanza strategy, their instincts, combine this with stress tested allocation and scenario planning, and you can build a portfolio that survives the crash and also benefit from the recovery. In investing, the real skill is not perfect timing. It is staying invested even during crashes, planning for the worst. Please let me know in the comment section, would you like to try Costanza's strategy, which is investing even when market seems very high, or does it feel too risky? Also, please let me know if the market falls 20% tomorrow, would you invest more or stay put or sell? Comment below. I would love to hear your thoughts and engage. If you like the content of this video, please hit the like button, share it with your friends and subscribe to this channel.